The Hedgeless Horseman here. It's April the 7th, 2025. Uh, First of all, thanks to my sponsors. I thought I would talk a bit about, well, the volatile market as of late. I guess one could say that some people might need some copium, but I like to call it common sensium. Uh, so let's dig in. As you're probably aware, there's been, 3 days? I think at least. Well, 2 days with pretty, or has it been more than that? Well, the tariffs went into effect April 1st, I'm pretty sure. And then the market kind of got spooked. And what's funny about that, or about this, is that, I mean, there were some analysts and articles published before April 1st, and they kind of said that, well, I should say that some analysts or articles, they expected the market to rally on April 1st, and instead they started, well, kind of crashing actually. I think Nasdaq is down 20% or something. So even though, I mean, it's from very, very high levels. That's the thing. It's like the US markets, they were trading at abnormally high valuation, super high, longest bull ever, and they correct. Of course, if you're used to that, if you see nothing but mostly a climbing market for the last, I mean, now it's up to what, I don't know, 14 years, whatever. I mean, there's been hiccups in between, of course, COVID flash crash, but that was over in a week or something. But you're used to that, so you're used to seeing stuff going up. So this is a big shock to a lot of people. I mean, if the Nasdaq goes down 20%, you can guess what the junior tech company did over that period. And I think like Russell 2000 went down even more. And today it looks like, I think, what? I thought this was the, okay, let's look at index future. You can see how red it is. I mean, I think during the night it looked kind of a somewhat red opening, let's say. I mean, actually, Europe is already open, so Germany is actually down 5%, France 5%, Great Britain 4%, Italy 5.6, Swiss, yada yada. China is really taking in water now, or I shouldn't say taking in water. I don't like the term where it's necessarily taking on water like something is a ship is sinking, getting worse per se. Prices are going down at least. That's all we can say, right? We're seeing that prices of large cap stocks, and thus mostly low cap stocks as well, are going down. And I mean, we haven't seen numbers like this in quite some time, not in a day. And this is like the third or fourth day of red numbers akin to this. So it's unusual for sure. It's a very quick drop in prices in a short period of time, and this is not something people have seen in a long time. Of course, in the mining and junior space, we're used to this. I mean, this is a shock to a lot of people if they have their large cap go down 5% in a day. I mean, we know in the junior space, I mean, a 5% up or down move is like, well, that happens pretty much every day, almost every other day. So we're kind of used to it. I mean, in some sense, not that one should have Schadenfreude, but like now some people are getting a taste of what it's been, felt like in the mining space since 2020, so around 4 or 5 years. I should say 4 years maybe, because I do think the bottom was in 2024. last year. But it's not, it's been a gradual rally. I mean, it's been a selective rally. Some stocks have done really well. And I'm talking about the juniors. The gold producers, the big ones, the majors, the mid-tiers, they've actually gotten credit for the extremely high gold price and abnormally high margins. The gold sector is kind of as profitable as ever, and they reflect that. They haven't gone to overvaluation, I would say. I mean, Agnico has gone up, Alamos Gold has gone up, and Lundin Gold has gone up a lot, but still, I mean, their charts look great and all that, and they've gone up, but they've gone up because fundamentals have gone up the same way. And I wouldn't say they've reached overvaluation, even though I'm not keen on buying them because I don't think they're super cheap. They're not cheap enough for me, but I wouldn't say they're overvalued. Whereas like a lot of stuff that's sinking now, especially in the US, I mean, I think it's the, again, broadly speaking, highest valuations we've ever seen in the US. At least for the Mag 7. And, well, this is also one thing I was gonna, well, we can get to that later. Let's look at commodities. The night started off very red. I think, where's silver? Silver was down quite a bit. I think it touched like a 27 handle or something during the night. When I went to bed, silver was down like 1.6%, the futures. Now it's up 3.83. That's a 5% swing. But silver had gotten absolutely slaughtered, of course. Same with copper, but copper is actually rebounding now as well. Yeah, so copper was down, I think, maybe 3% or something. So huge swings. Excuse me. Of course, the thing is, with these tariffs, is like copper is exempt. Gold is exempt. Silver, I don't know if it's exempt. But like, if we're talking risk, okay, or I should say, okay, tariffs happen. US puts tariffs on the whole world. A lot of dislocations. Some countries have a lot of exports to the US, up to 30%. Some have only 5%. Whatever. So obviously, everything that the US exports gets a tariff on it. But every other country doesn't export everything to the US. So the US is at least the ones that's, in a sense, mostly impacted, I guess. Even though, I mean, they don't import everything, but everything that's imported gets a tariff on it, except copper and whatever. And then, of course, the funny things like, yes, copper and base metals, especially in the commodity space, have sold off. Why? Well, people are fearing a global recession. Well, that's part of it, of course. I mean, as soon as some selling starts, there's so much momentum trading, so it's like, just because it's red, people will sell and all that. But let's say what kicked it off was the idea of the odds of a recession or a global recession even. But at the same time, I mean, we don't know how this is going to play out. Nobody knows. Obviously, it can lead to higher prices in the US. But I just saw a short clip of President Trump where he's talking about, I don't know how much he expects or says that they're going to get in from tariffs, and that they're going to obviously rebuild a bunch of stuff in the US. Who knows? I mean, we've seen that infrastructure is badly needed, badly needs upgrading in the US, and if all these companies now is like, we don't want to pay those tariffs, we can't compete in the US, so we have to build them in the US. So who knows? I mean, if there's a big construction boom that happens in the US, onshoring, and maybe the government can make some investments or give grants or whatever, help to make investments. Who knows? I mean, then we might have, we're going to need a bunch more copper all of a sudden. I mean, you don't know. And then, of course, I mean, the flip side of that coin is, well, that, okay, well, if China's factories won't be needing as much materials because they're not selling as much to the US, for example, well, then they don't need to spend as much on whatever, and their copper consumption goes down. So who knows how, how the net benefit would be, and of course, we don't know how long these tariffs are gonna stay. If there's gonna be more tariffs, it's like I have absolutely no idea. I don't even try to guess this. It's like, I had a family member call me. It's like, what do you think about this, these markets? And said family member had some money to put into the market in the junior space, and I was like, I don't know. Nobody knows. I'm not a market timer. I'm not a macro expert. I mean, everybody cares about macro. It's very interesting. I find it interesting as well, listening to what people think is going to happen and think what it might mean or whatever. But it's like, how many actually make any money on macro calls? Almost nobody. I mean, you can take Michael Burry, for example, the famous one from The Big Short. I mean, he made a lot of money in, what was it, 2008-9. After that, I mean, he became a legend, of course, and also thanks to the films. Uh, but he's expected the market to crash at least a couple of times in the last few or several years. And the US market hasn't. My point is, like, you might get one right once or twice, but it's very, very hard to be a serially successful macro caller. And we've seen that, again, I'm invested in mining stocks, junior mining stocks. And we saw it, even if you were right that gold was going to hit 2000 again in 2021, the juniors didn't really follow up. If you were right that gold was going to hit a whopping $3,150 per ounce, and the cost structure hadn't followed, so the gold miners would have record profits. That an ounce in the ground basically hasn't been as valuable as it is now in decades. You would think that the junior sector, especially the gold juniors, would have gone absolutely ballistic, pricing in that their ounces in the ground, or potential ounces in the ground, never had more value to them at the time of speaking. But that hasn't happened. So, my point is, even if you get some macro thing right, you don't even know what the flow of funds is going to be, let's say. But with that said, a lot of people are looking at ratios. S&P to gold, S&P to GDX maybe. I've looked at NASDAQ versus the Hue index, mining index, which has been breaking down like it did the last time it first topped at a level as high as this, which was in 2000. And that was, when that topped, that was the start of an 11-year bull market for gold miners. And it has topped and it's been going down. I mean, theoretically it could go up and make a higher top. Now it's at least crashing down. And today we're seeing gold green, and we're seeing US Tech 100, NASDAQ 100 is down. S&P is currently down. Europe is down quite a bit. So I expect, I wouldn't be surprised for that ratio to come down even more. So that is the thing, I think. Again, if we're looking at flow of funds, not just, macro, flow of funds, obviously gold and the gold miners have been outperforming the US stock market indices lately. And again, what does everybody want to be? Everybody wants to invest in a bull market. Everybody wants to invest in what is, quote, working right now. Because if it was up to valuation, nobody would be buying this, Nasdaq Mag 7 shit at these valuations. But that's not how it works, right? And that's not how fund managers work and all that. And I said this before this, the sell-off happened, that I had looked through a family member's pension funds, and I tried. And since the U.S. had just gone more and more expensive, I was trying to I tried to reduce the exposure to the U.S. sectors or the U.S. markets, purely from a valuation standpoint, not market timing. And I found that even the funds that were so-called global funds, they had 70% exposure to the U.S. and Mag 7 was like in the top 10 in almost every one of them, like 5% positions, like really large positions. Nvidia at 5%. Like I'm like, holy crap! I mean, no wonder these have gone up so much, because the supposedly global pension funds, they're all in Mag 7 as well. They're all in the highest market cap companies. So it becomes, as a lot of people have said, the passive fund investing has become a momentum trade. The bigger the higher they go, the bigger their market caps, the bigger the allocation in funds. So it's just crazy. That's like, oh, every unknowing pension savers like puts money in some fund or what, passive fund, and 5% of that money goes straight into Nvidia. I mean, it's absolutely crazy. And of course, what happens then on the way down? Well, if everybody has piled into Mag 7, every pension fund, and let's say that starts to underperform, well, that's probably going to get a lower allocation, so there's going to be less money into those names. So not only selling, but like less buying on top of it. And again, who knows what happens if the gold sector keeps outperforming? Maybe more money goes into it. Maybe sometime down the line, some pension funds need to have exposure to this outperforming sector. That's what's, I think, really gonna move. I mean, the gold space. And one thing that's also interesting was that Friday, when the stock markets went down quite a bit as well, and I think silver was crashing especially hard, and gold was actually down. Crypto actually kinda held in there, and I got a lot of messages like, it pains me to see that Bitcoin is actually not going down. Instead, a flight to safety deal. That it is actually because the other days it has crashed along with Nasdaq and the stock market, like it tends to do. Like it has a beta to the high, it's a risk on trade basically. And all of a sudden on Friday it didn't really sell off, and some people are like, oh, maybe it's a flight to safety. But then I looked at the crypto space overall. Even Dogecoin was up. All the entire crypto space was kind of hanging in there, up 2% or whatever. Dogecoin is obviously not a flight to safety, or any other of the 64 million coins, or how many there are, tokens. So that I don't buy at all. For some reason, there was simply not much selling. But who knows? Nobody really knows who owns the stuff anyway, right? And it's heavily manipulated, so you never know. Might be a few. I mean, since it's a quite illiquid market and all that, and you have some big whales, maybe the whales simply weren't selling that day, or something. Maybe Tether printed a bunch of fake money and bought it up, but it wasn't crashing. But now it's all of a sudden it's back to crashing today. So my thinking was like, well, I mean, if you think that the glorious Mag 7 tech, AI, whatever, momentum trade is kinda losing steam. It's going down. It's not the momentum trade where people don't care about PE ratios and anymore, and there's no money to be made to the upside because everybody's in. whatever, or fundamentals matter enough all of a sudden that, I mean, if you had a PE of 80, for example, on some company, and now they get hit with tariffs. I mean, if that's a high PE as it is, maybe if it goes down 20%, it will still be at, P80. So it needs to go down even more. I mean, obviously that's why after bubbles the crashes are so hard, because they get overvalued on unsustainable PE ratios, let's say. But if the profits gets cut in half at the same time, I mean, if the price doesn't go down 50%, it's at P 160. But what if it goes down, the profits gets cut in half, so it needs to go down 50% to still be at P80. But P80 is so high that it's like a more reasonable PE might be 40, and then it has to get cut in half again. That's how you have these bubbles, and then they retrace like 70% or whatever some. And the same goes for how the gold mining space kind of acted. I mean, if you go from record margins, and let's say you have very high multiple on that margin, and then we reach 2015 when the mines were barely making money. I mean, all of a sudden any PE or most don't have profits. So it's like, yeah, you can see how stuff could go down 80% because that's the difference. Going from unsustainably, let's say, high margins plus bubble valuations on those high margins to almost no margins. But I mean, I had a lot of fun. It's like I spent my most of the last week I spent on just let's say trying to hype people up, trying to show that, I mean, because if we're talking what is risk, Nike went down 14% in one day. It's probably down a lot more than that from the top. But is that understandable? It's like, is that just panic selling? Well, Nike, or all shoes almost, I think, in the US gets imported. And most of those shoes are probably made in some sweatshops in like Bangladesh and Vietnam and stuff. Who got hit with high tariffs? So basically, if you're Nike and your merchandise gets imported, pretty much all of it, and all of that you have to pay all of a sudden 10 to 30% tariffs on. That is a huge change to the fundamentals of the company, right? You either have to hike the prices by a lot just to keep the same profits. But if you do that in times like this, especially maybe since there's so much turmoil, when there's dislocations, are you gonna have the same sales volume? Or are people gonna buy as many shoes if they pay 10 to 30% more? I don't think so. That has a direct impact on Nike's business. There is an upheaval in their business model. It makes sense that Nike would have lower profits, at least in the short term. Right? Because it happens like that. Tariffs go into effect. All of a sudden, if they have the same prices on everything, they don't make much money. That has direct business implications. So the value of the Nike business goes down, and price should reflect that and go down. But let's look at the gold space. Oil has been absolutely getting whomped. Oil, gasoline, diesel, is a huge impact or huge input cost, or quite large for gold miners, especially open pit miners, because there you have these fat trucks go day in and day out all the time, and they're basically guzzling up diesel and gasoline. So all of a sudden the cost of operating your mine went down. And there's no tariffs on gold either, even if that would be important. So the costs for operating mines probably went down quite a bit with oil because it's such a huge thing. But yes, if you're in the US, maybe some of your other inputs like chemicals and whatever, maybe they get slapped on with a tariff. But I don't think it's going to be that big actually. But for international miners, they don't really get extra tariffs. I mean, they're not if they have a mine in Europe or South America, are they importing stuff to the US then? No, they're not. So that didn't necessarily change for them. Maybe even there's less demand on some of the input costs, like copper is going down, which is needed in some whatever, some ball mill or control panel, yada yada. So who knows? Maybe miners are gonna see lower input costs because gold or oil surely did go down, but gold surely is still about $3,000. So IMO with gold oil crashing. So maybe the gold mining business is going to have even better times post tariff dislocations because there's going to be less competitors for some materials or some gadgets or whatever that they need to operate their mines. So there's literally no real reason that I can see that the gold miners should be down much. Because the gold business does not seem that impacted. If anything, maybe the gold business actually has become a bit better since the tariffs went into effect. So there you have that, in my opinion, then is irrational selling. That's selling because, well, who knows? Because, I mean, well, to be frank, I don't know how many times I've heard people say for years now, I mean, for years, well, every year, every month almost, people are like, aren't you afraid of, a market crash or whatever that takes the juniors and miners down with it? And it's like, no, because I have no idea when it's going to happen. If it happens, I don't know how it's going to look like. I don't know how quickly it will be over. I don't know if it's actually going to impact the mining sector much from a value perspective. Because now, okay, yes, recent week, juniors have sold off, right? And for the last 4 years, the markets haven't even gone down. And still the gold junior or junior sector sucked. So, again, case in point. The markets didn't crash up until now. Gold price performed, margins expanded to record highs, and still there was no real the gold juniors, the juniors didn't follow along. So that's another example of, even if everything happened from a macro perspective that we could ever dream about, and still the juniors didn't follow up. So my point is, I guess now the markets are crashing, and now they're taking juniors with them. There was some panic selling. That's obviously again irrational panic selling. Well, in some cases it might make sense, because if you think, well, this is a shit co, and they don't have much, and regardless if the gold business is unchanged after the tariffs or even slightly better, access to capital is going to be a problem, whatever. Because you're just, if you have a shit co, a trading sardine, lifestyle company, that company is around to feed off new money. They're never going to get monetized. They're never going to really do anything. But they need money to just stay around as a trading sardine. And if there's less capital, if there's less money to go around, there's less appetite for quote risk, they might have more problem raising money. So it is impacting. Just the fact that access to capital might be shrinking in light of this is a risk to some companies. But there's juniors out there that are fully carried, by majors who are printing record money, so they're like a cash flowing monster that's funding it. It's like, well, they don't really have a problem. Newmont or whoever it might be, they have more cash than they know what to do with. Agnico has more cash than they know what to do with, and they're printing record amounts of cash today, post tariff, um, post tariff implications. So how risky is it? I mean, not really risky. I mean, there's obviously example like Inflection Resources. It's a pre-discovered junior, so at face value it's very risky, but they're fully carried by Anglo. They're taking management fees, so they're actually generating revenues, plus they're fully carried by Anglo Gold, who's probably making record cash flow. What's the business risk to them really? Nothing. They're not anywhere close of going bankrupt. They don't even have losses. They're making money, plus they're getting fully carried. So you have juniors like that, where it's like, hey, their bank is a major mining company, and they're making more money than ever. So why should they? What am I panic selling for? You're obviously just panic selling because you think somebody else is going to sell it lower the next day or whatever. But it doesn't. No, I mean, it's not because of risks. Again, the Nike stock going down, that makes sense because their business suddenly got hugely impacted in a negative way. So this is basically irrational panic selling, and that's why I spent again most of the. Well, first of all, it's like if you just think it from this perspective, okay, 95% of people lose money because they trade with their emotions, right? So what do you think? Who do you think are selling? Who are the panic sellers? Is that smart money? Of course not. What's the hardest thing to do when the world seems to be on fire? To buy. So just knowing that, oh shit, it's a highly emotional, negative sentiment environment, and I'm able to buy, let's say, or not panic sell. Well, then you're in the 5%. Knowing nothing else, basically. If you just do the opposite of what everybody else seems to be doing, you're obviously a contrarian. Right? And the same goes for when things go exponential and everybody's falling over themselves to be buying and buying it higher. If you're selling into that, you're obviously taking a stance against the herd. Regardless of what it is you're selling, what sector, what asset, you're doing something that few are doing at the time. And I'm just trying to, again, it's like I get off on this stuff. I like volatility. I like dislocations. Volatility is the poor man's dry powder. Because you never know, some junior might, there might be some guy with a stop loss in. I never use stop losses, but it's like, there's a stop, I mean, I saw some juniors on Friday, they went down like 26% for a while. And I was getting all excited, like, holy crap. Because again, I'm going back to the fact that the value of the gold business did not go down. Prices went down. That's a huge opportunity. I don't care if they're crashing from a low level. That means that, oh, it's a really cheap case just became extremely cheap. This sector is unsustainably cheap as it were before the tariff dislocation. But the main thing is that many of these, especially the higher quality ones, they are not risky. The gold business itself did not add on a bunch of risk with the tariffs. The gold mining sector might be one of the few sectors that actually probably became more valuable. And they're still getting sold off because people are fearful, panic selling. They're selling just because they think someone else is going to sell tomorrow. Because you can sense that, because that's what everybody keeps talking about. And have been for the last, well, forever, basically. oh, should I really buy now? What if the market crashes? And the market didn't crash, hasn't crashed until now, and still they didn't perform. And now they're crashing, and now they're, oh, it's time to sell. So I'm trying to, I did a lot of, posting a lot of memes, whatever, just to get people's spirits up. Like, this is the time to be aggressive. This is a go time for a contrarian, or if you want to be in the 5%, you got to be able to do what the masses are not doing. And for sure, again, I can look at a specific case, see that, well, this is not even high risk. The risk didn't go up with the tariffs. Especially, I mean, the best cases, again, to use that example, are the, let's say, fully carried, cashed up, or revenue generating juniors. Because they have no access of capital risk. The risk did not go up. The one that's funding their exploration, let's say, they actually probably are making more money post tariffs, and they're gonna have record quarters. They're not anywhere close to going bankrupt. Not anywhere close. They have tech margins right now, in one of the only sectors that has still just keeps getting better and better. So it's like, here you have a case. Goliath got sold off, and I've talked about Goliath before. It's like, warrant exercise, people are, it's like, okay, there's not really in the ground yet, yada yada. So plenty of reasons for momentum traders not to be in it. But you're and I think there's going to be more. I think there's going to be more filings around the space in this period. So it's like Roger Rosmus bought 20,000 shares at $1.40 for 28,000, adding to his almost 2.7 million share count. So there's people right now out there that are panic selling when they're selling assets that, if anything went up in value, for 20% less or whatever, and they're selling that to insiders. Does that sound like a smart idea? You're selling something that, if anything, it probably has gone up in value for much lower price than you didn't sell it at a week ago. And who are you selling to? Insiders. And other people, in my opinion, smart money contrarians. It's like I said here, give me a 10 million loan ASAP. I mean, this is the most painful thing there is. This sector, I was already 10 out of 10 in bullishness. This happens. They sell off again without value going down. They just go down in price. And I'm like, Jesus. Now is when it's really hurting that I don't have a lot of dry powder. But then you have to be creative. Yeah, many juniors are cashed up. Some are free carried by producers. Said producers have record margins. Still they're getting panic sold like the above was not true. I love this sector. Again, obviously this is irrational panic selling by people who probably never made any money. And to my point here, your mentality on days like this says everything. This is what you need. You need days like this or periods like this, because that's the only way to know how far you come. It's easy to talk shit and easy to buy the quote dips if something has gone up and it dips 5-10% or whatever. And we're going to get to another quote, which is great. It's easy to be a long-term investor and keep buying dips. You see it all the time. I mean, usually I should have the short upwards, like some guy bought H&M. It had gone exponential, and then when it dipped from, after it had rallied for like 200%, it started dipping, and then he was gonna buy the dip. He started buying that dip. He bought right into it wasn't just a dip, it was a bigger correction that lasted maybe at least 6 months or whatever. So he started buying on the way down. Then when it kept going down, he flipped to selling, and he sold into the lows and then it started to go up again. That's absolutely the opposite way how you're supposed to do it, of course. But it's easy to say you're buying dips when something is going exponential or in an uptrend. And you're not looking again at valuations. You're just seeing that, oh, it's cheaper than, I missed 200% of the run, but now when it's starting to correct, now I'm going to be a contrarian dip buyer. This is obviously something else, because now we already have a depressed sector that's gets sold off for, again, no good reason, because value surely didn't go down. One can pretend to be rational and have a buy and low, sell high mentality, but for most it goes out the window when it matters. That's just the truth. Times like this is perfect time for self-reflection. Are you looking at these prices going down and getting fearful? What are you fearful about? Why are you afraid of buying? Why do you want to sell? If you're honest about it, you know that it's just an impulsive reaction, that you're fearful of buying because you think they're going to go down more in price tomorrow and next week. That is typically the main reason why people sell lows. Why? Because why else would they sell? Who would sell record cheap gold juniors when they go down another 20%, when value, if anything, has gone up? You cannot explain that from a valuation standpoint. You can't point to them and say, well, they're expensive, so I'm selling. No, you're just afraid that they're going to go down even more. So you're a market timer and a momentum trader. So that tells you what you do, or your mentality right now, times like this, tells you everything if you're a sheep or if you're a wolf, if you're a contrarian or a herd follower. And I'm trying to, because obviously again, it's easy to, and this goes for a lot of whatever experts and pundits, etc. It's easy to talk shit and talk about how I don't know, how good you are or how much money you're gonna be making if in an uptrend or whatever. I want to be out there. I want to be vocal when it actually matters. On up days, I don't tend to talk too much. I don't talk about, you gotta buy the lows, whatever, because they're not even down. And a lot of people, obviously, since I'm 100% invested. So do you think my portfolio has gone up the last week? No. Do you think I'm looking smart on paper over the last week? No. And most of the time then people close themselves off. If you're a junior mining bull and you're openly bullish as hell, and then this happens, then because you're looking stupid, then you don't maybe dare to even mention, I am in, junior miners, whatever. I don't give a shit about looking right in the short term. What I care about is my long-term portfolio performance. And the only reason I can suffer big corrections and bear markets even is because I always buy the lows. I buy more and more the cheaper it gets. That's what bails me out every single time. I have no idea when stuff bottoms. I have no idea when they top. But I'm very good at just keep buying when stuff is cheap. I'm very good at buying panic sell-offs. So I'm just trying to be at least, let's say, one voice out there at times like this, where I push the pedal to the metal, and I go on the offensive even more, and hopefully snap some people out of the mentality, because again, most who, let's say, might be bullish, especially when times are good or things are going up, they tend to get quiet when things are going down, because they look stupid if they were bullish a week ago and whatever, and they're sinking as well. Maybe their portfolio is going down. I'm not going to say, again, I shouldn't use that word sinking. The prices are going down, and you look stupid, and especially if you're out there making calls. It's like I don't really try to guess where silver and gold is going, or where the juniors are going in the short term, because obviously if we go up, back a week when silver was up at $35, you saw a lot of calls for, now it's supposed to, trigger something and we're gonna have a quick rally to 40-50 bucks. Instead, now the opposite happens, where it drops like, well, from 35 to 27 in a week. Obviously, you're looking very stupid at that point in time if you're a directional guesser, yada yada. So you tend to get quiet. And most people also don't really make much money, and they feel shit when their portfolio is going down. And they don't, their confidence, let's say, goes right out the window. And they don't want people to know that they've been in junior miners, because they're in a sector then that has gone down. I don't care about that at all. I look stupid plenty of times. I'm, again, very bad at market timing. Most of the time I probably buy more short-term tops than bottoms. But thankfully this sector spends so much time correcting since 2011 that there's plenty of time to buy low. And 20% it just rallies for whatever reason, let's say. And then I was kind of, somewhat, ridiculing it. Again, these posts, these memes, is to try to get people to snap out of it. Hit them stop losses, make them flee in terror. Why am I saying that? I mean juniors. I'm trying to make a point here, that this is fear and stop losses getting triggered. And people are, again, automatic selling, panic selling, stop loss selling, people, fleeing in terror. Again, from what? What are you fleeing from? Some of these juniors aren't risky. I would say there's probably a lot of large cap general companies that are more risky than some juniors right now. But that doesn't matter, because that goes right out the window. They're just feeding on the fear out there across the spectrum, and that influences them enough to sell. It makes total sense that somebody would sell Nike stock if the tariffs impacts their business a lot, impacts their earnings a lot, their sales volumes a lot. It makes sense to reprice that company. Panic selling never makes sense, really, or panic buying, because it's emotionally based. But some companies have a good reason to be priced lower. Gold miners haven't even seen their businesses go down in value since the tariffs. Yeah. And again, feeding into, this is what it's like. I take pride, in a sense, from being able to be bullish. The more fear I see out there, the stronger I feel from being bullish. Somewhat of a, ego thing, but I take pride in it. To be if there's 90%, or if 100% are bearish, if I'm 100% bullish, I feel proud about that. Like the matter, or if you remember the movie Ferdinand, I don't know what the actual title is, I guess in English, but we in Sweden we have there's a segment with a bunch of old Disney clips that go at every Christmas Eve at 3 p.m. And one clip is from the movie Ferdinand. I don't even know if I've seen the actual movie, but my point is that when they're in the arena, Ferdinand is in the arena, and he's supposed to be the most vicious bull the people who gather up bulls were able to find. But in truth, he's more of a gentle soul who only wants to sniff his flowers and sit under an oak tree. right? And the matador gets absolutely furious and starts crying because Ferdinand won't charge him. Because how else is he going to be able to show how brave he is unless the bull charges him? If he doesn't get charged, he can't show how brave he is or how skillful he is, whatever. So he needs that bull to charge him, to prove to himself and to other people how brave he is. So he obviously, again, an ego thing there. And we need days like this to prove how rational we are. That's why I also said before about a bunch of people have paper strategies where it's like, oh, again, oh, I'm gonna do this if that happens. Or oh, I'm gonna ride this case. Oh, this could be a 10-bagger case, whatever. But it goes up 50% and you sell off because you can't. You're so afraid of losing your profits that you sell. And let's say it was a high risk, high reward case where it's like, well, this is a high risk case, so you need to have, let's say, a basket of 10, 20 small size positions, and they're high risk, so most of them won't work out. Then you need to play the reward side in the few ones that do play out, or where the reward side manifests. So you might need to play them for whatever 300-500% or something. Stick to them in like for like 2-3 years. But in reality, that typically does not happen. As soon as people see green, because if you have 10 high risk juniors, most of them are going to fail. So you're going to get scared. So when the one that's might be working out, you're going to be selling that and running with your quote profits. But all in all, you look across your high risk, high reward portfolio, you had, let's say, 8 stories that failed, went down 50-70%. You have 2 stories that would end up being the high reward cases, where the high reward side of the high risk, high reward equation actually was going to play out. But you sell those cases after they're up 50-100% because you're so afraid of losing money. That's not going to pay for the 8 other cases where the high risk part of the equation played out. So on paper you have a strategy, high risk, high reward cases. In reality, you just play the high risk, low reward strategy. So again, good on paper, you can't put it into practice. Days like this, if you think you're a contrarian, you think that you can buy low, you think you can be, let's say, among the 5% who actually does the opposite or does the rational thing when people trade irrationally. But if you get scared as hell and you also sell because you think it's going to go lower tomorrow, you're no better than 95% of the people who actually does the exact same thing. So times like this is the only real way to know if you're actually mediocre or exceptional. And I know how it's also going to be that if you sell today and it goes lower tomorrow, or goes lower for a week or 2 months or whatever, if you sell for an irrational reason, you're guessing that it's going to go lower, and it happens, you're going to think, oh, I'm so smart. It went lower. I'm so smart. What you don't see are all the other times, because this is going to probably teach you to, you're going to be a seller when you think it's going to go lower. So let's say you get one time correct. Then you have 10 more, let's say, dips or corrections. And you try to do the same thing. You think it's going to go lower. But let's say 6 out of 10 times it doesn't go lower. Or maybe more than that. My point, and you miss the bottom. My point is, it's very costly in the long run selling bottoms. If you're even near a bottom, all of those buys are probably going to show huge profits. This gets me to, let's take this one. This is a junior silver stock. Let's, for all intents and purposes, let's call it a trading sardine. I think, yeah, this was here you had the 2016 rally. I think this was maybe a couple of thousand% maybe. And then you had a 4-year bear market from 2016 to 2000. Well, I think this was the flash crash actually. I think overall the bear market in the miners ended in like late 2019. Regardless, okay. Here we have a cyclical junior in a cyclical sector. And this is a 4-year gruesome correction. And I sat through this entire correction with my full invested junior portfolio. And I remember how, this was a real grind. It just never went up, just grinded lower. And my point about, let's say, selling low is that, okay, let's say, whatever, you sold here, it went lower, you're feeling smart. Here you're going to think it's going to go lower as well, so you don't buy, then it goes up. And if you're a market timer, I mean, let's say you drew a line like that, okay, this looks like some sort of a breakout, you're probably going to buy that because now you think that the trend is up. Wrong. Turned around, went down even more. Maybe you sell here again, thinking that it's going to go down. Whatever. Went up, then it turned around again. And down here, it's broken through supports. It's broken through whatever, a bunch of trend lines, let's say. So you're probably not going to be buying this either because you think it's going to go even lower. From this low to the high, which was just, 6 months away, 1,748%. If you look in hindsight, from a bear market to a cyclical top, and this was a high sentiment top, this was 2020 when gold hit 2,000 for the first time since, well, ever, basically. Outrageous returns, right? If we look back, every single buy during this entire bear market turned into a profit. In hindsight, every single sell down here was bad. Even this is a great return. But you had to sit through 2-3 years before you got the 164% return. And if you bought all the way down, at this point, 100% of your buys you were down on, looking stupid. My point is, if you're buying anywhere near cheap levels of bottom, probably on average, every single buy is gonna turn out to be a good buy. And by definition then, every sell in a vacuum is gonna turn out to be because if we reverse this, if you sold this, you sold a 520% opportunity. If you sold this bottom, you sold a 1,748% opportunity. I don't know exactly where we are. I think the bull has already started. I don't know if we're near a and it's dependent on the exact junior, of course, and cases change and all that. So I think we're past this point actually. Not in every junior. I mean, some juniors might be near their lows. But on average, I think we're more like having one of these type scenarios. Or in some juniors, we might be near this kind of scenario. And this is what the sector always does. always crashes, always gonna rally. And I know people, it's like I talked to a friend who started investing in the junior space around 2000, 2021, and he has the same fears as a lot of people. Like, well, I have never seen any evidence of a raging bull leg or a bull market. So he has never had the experience of one, never seen the evidence of one. So in his mind, if he's bullish, he has to believe in something that is never seen. And I've said it a bunch of times. It's very understandable if you bought into if you started buying in the 2020 period, you've never seen one of these. And that's obviously why people also sell, because they see no evidence of this ever changing. And I've seen people say, I think this sector might never change. It's different this time. But that's also what everyone selling low said at this bottom, and at this bottom. And we can go back and look at any bear market, capitulation, selling period, whatever. Everybody sells. Every sell turns out to be a stupid sell, on average sector-wide. But if you're in shit coast, those are never really buys to begin with. So it's not the same. I'm not, and I've said this before, when I'm saying, buy the dips, buy when it's cheap, I'm not talking about buying trading shit coast that I would never want to buy because they have no actual value. I'm talking because I'm a stock picker first and foremost. I'm excited about the fundamentals of the companies I'm buying. The future share performance is a byproduct of said fundamentals playing out. And here I'm just again ridiculing it a bit. Flee for your lives. Again, like the world is ending. Despite the fact again that the gold sector is pretty much at all-time highs in value. I'm having fun. Thankfully it's not illegal yet to panic sell from already low levels. Now again, what we've seen the last week is more evidence how you can beat this sector, or how you can beat the market, how you can make money. Because there's again, totally rational to see the Nike stock sell off because they have huge impacts from the tariffs on their business model. Gold miners with a crashing oil price and almost record high gold prices, they're probably going to have record quarters. Their business is as good as it's ever been, and the gold juniors still sell off like that wasn't true. That's irrational selling. That's panic selling. But if you have huge funding problems for a junior, if you have a shitty project who feeds on easy money, yes, even lower access to capital, more risk-off environment, that might have actual impact to your shitco. But the legit projects and all that, their MPVs are probably, I don't know, 10x what the juniors are selling for, 20x. And this is a good point. If you have a small portfolio and can easily reshuffle meaningful percentage positions, a day like this with stop loss selling is a license to print money. Why? Because if you have 20 unchanged cases, let's say 5 of them go down quite a bit, 5 of them go down a lot, with stop losses getting hit. So you have unchanged fundamentals, you like the cases equally much, but if 5 of them go down 20%, they don't become 20% better buys. Those 20% corrections might be something going from whatever, future 520% return, or let's say, should maybe have something more interactive, but let's say they go from here to here, and let's say from here you would get a 400% return, and down here you would get a 500% return. That 20% extra price decline created an extra 100% future reward. 100%. That's years worth of returns created from panic and stop loss sellers within a week. So you got an extra one bagger in a case in a week thanks to panic selling. Again, years worth of returns, future expected returns. From 1 week, in 1 week, the company didn't need to do anything, they didn't need to find anything extra. It was just panic selling that created extra reward. In good times, you need a lot to happen for something to double. Like they make a significant discovery. Or they get bought out at a huge premium if they're already, almost fully valued. But the future rewards, the risk reward in juniors, when risk does not go up but prices go down, the cases go absolutely exponential from a risk reward perspective, absolutely exponential. So if you have a small portfolio and you can easily grasp the opportunities in a big way. I can't really do that anymore. I mean, a lot big or large parts of my portfolios are in private companies, so I can't even value shuffle. But some, I do it from. I mean, I did some value shuffle last week, and I mean we're talking 0.3% of my portfolio. Unfortunately, I can't really get into place with bigger position because usually these are quite illiquid cases. But if you're running a $20,000 portfolio or something, even maybe $100,000 portfolio, you might be able to reshuffle if you have $20,000 portfolio, you might be able to reshuffle the whole portfolio or something. So you had, let's say you had 20 cases. 10 of those cases go down 20%. Unchanged fundamentals. Maybe they're already your favorite cases, but let's say you had them evenly spread out in 5% in each. You could theoretically sell half of your portfolio that went down 5% and just own the 10 companies that went down 20%. So yes, your portfolio went down, but your future returns on your portfolio went up a lot more and are more than gonna pay for that current paper decline. Because, think of it like you had on average before the sell-off, on average your portfolio was gonna average 400% in the next 3 years. Portfolio went down, let's say 10% on average, but you put your portfolio in the 10 names that went down 20%, and they're gonna generate 550% in the future. So now your future expected returns for your portfolio is 550% instead of 400%. And that's also going to pay for the 10% decline. You created you created portfolio returns. You created portfolio performance even though the portfolio is down in the short term. You can't see the future returns. You can't see that you actually got anything out of the decline. But your future portfolio size is going to pay testament to the fact that it's now in the future it's going to be bigger than if you hadn't, let's say, value shuffled and taken jumped on those opportunities. So I mean, I mostly do value shuffling, even though it's not does not have a necessarily material effect because I can't really value shuffle that easily since my portfolio's grown. But it has grown because I have done value shuffling in the past, and it just helps me to keep sane because I feel really really good when I can take an advantage. It doesn't matter if it's if I put in let's say $1,000 in something that was unreasonably cheap and got a lot cheaper. I don't care if it has no real big impact to the overall portfolio. It just feels good knowing that I just, let's say, quote, stole from Mr. Market. I know he's making a mistake. Regardless of how small small of an amount I'm gonna take advantage of that, I'm gonna take advantage of it, and in the future my portfolio is just gonna be a tiny bit larger than if this panic selling hadn't happened. So it's more of a, I guess, a therapeutic thing, because I never want to feel. I always want to feel like I'm taking advantage of the market. And if you listen to Howard Marks, he's like, I'm not even trying to guess. I don't believe in macro forecasting, my own or other people's. Again, I don't care about macro. I don't know what the rates are. I don't know what Fed is going to do. I don't know what's going to happen with the tariffs. I just look, what's the value, I think, of these juniors right now? If it's multiples of what they're trading for, that's a buy to me. And if I'm on average right, I can suffer a lot of negative surprises from a macro environment, even on a case-by-case environment. And this from Howard Marks. Everybody runs from the market when prices go down because they think it connotes risk. It's just stuff going on sale. Why did Warren Buffett buy or sell a bunch of stuff? Yes, of course he might know. I mean, he's connected probably beyond belief. So it's not like it's impossible that he knew some shenanigans were gonna happen. But I would probably guess that the main reason was that he was selling Apple and stuff because he saw Apple as being the most expensive that it's been since he started. Since he owned it. Same with me, reshuffling a family member's pension portfolio, trying to reduce the exposure to the US sector. I didn't know this was going to happen. I mean, it's just that, I mean, bad stuff happens from overvaluation. The surprises comes to the downside. Eventually. The opposite is true for my portfolio. Anytime I'm just buying the shit out of any fat bear market or correction in this sector, sooner or later there's gonna be big surprises, and they're gonna be coming to the upside. In the meantime, they can come to the upside, to the downside, but yes. And from overvaluation, even let's say they're overvalued here, yes, you get a nice run. Maybe you added 60% from here to here, sure. Now it's even more overvalued. Boom, the big surprise is gonna be to the downside. So I think, let's put it like this, I think we're somewhere around here. Either here or here or here. And the big surprise is gonna be to the upside. I can't know exactly when, of course. I thought it would have already been started. It's like I said before, it's like I want to buy a new apartment, but I cannot sell these juniors. Because what's in store for the junior sector is that because we're at historically cheap levels, generationally cheap levels, I think the surprise is going to be to the upside in a historical way, sooner or later. That's the frustrating part. So if I'm selling juniors, I know I'm selling somewhere around here. And I know that sometime in the future, the money I used to buy something else the opportunity cost is going to look enormous in hindsight, I think, on average. Because there's nothing else out there I can buy that is this cheap. So even if you buy an apartment and house prices start to go up, and in 5 years they're up 20%, sure, if I'm leveraged on that, that's gonna obviously be a meaningful amount. But in that period, I think my portfolio is probably gonna be up 400 or 500%. That's the painful thing. When you know how good the opportunity is, you know what the opportunity cost is. But people look at everybody talks about opportunity cost in hindsight. I mean, here people are talking about the opportunity cost of not being in the sector or any sector. Down here, everybody's talking about opportunity cost like, oh man, this sector sucks, look at the opportunity cost. No, the opportunity cost is what's the opportunity at that very day. The opportunity cost is not a period of time. What is the opportunity cost here? People are going to talk about the high opportunity cost of having been in it. Nobody's talking about the opportunity cost of not being in it. That's what a lot of people get wrong, and they don't learn anything because they always look at hindsight, what has happened. Like people who are complaining about how good the Mag 7 has been. It's like, oh, I could be in the Mag 7, I could be in Nvidia. Well, what's the takeaway? Should you be in Nvidia now that it has gone up so much that gets you talking about the opportunity cost? No, it's worthless information. If anything else, when people start to talk about opportunity cost of not being in it or being in it, that's when you probably should do the opposite. When people are talking about this as opportunity cost, they're hyping themselves up to sell, where you should be thinking, where do we go from here? This is a really good article by Ian Castle, a bunch of, I think you should read this. And I mean, there's a bunch of good quotes. I mean, you can tell that, I mean, you can tell from the reasoning of some people, it's like they absolutely get it, because they're just full of common sense. Because, I mean, have a taste of this. In up markets, everyone tries to become long-term investors. In down markets, everyone turns into macro strategists, geopolitical experts, and market timers. It's like people throw this stuff at me all the time. But what could happen with yada yada? What if the market sells off? What if this and that happens? And market timers, of course. I can't buy now. And then, of course, like always, people with cash are gonna be like, oh, well, the funny thing is, like, if you have cash, I mean, it's a considerable amount of cash if you don't even need to. I mean, you are a market timer. That's like people say, cash is also a position. Yes, it is. But it's also a market timing position. If I look at my portfolio over the long run, I have beaten cash. I have beaten the rate on a savings account. So in a sense, I should never have cash. In a market timing perspective, I wish I had a shit ton. I wish I had a shit ton of cash right now. But that's okay, because I'm going to be losing money from the times I'm having cash and am not long. If that makes sense. Because if you have cash during the run-ups, you're missing out. I only care about maximizing, as best as I can, the long-term portfolio value. And that means I have big corrections and I lose out on having cash when I would want to have cash. But it also means that I'm fully exposed to the up moves and don't have a lot of cash that doesn't make anything during the up moves. Yeah, and I mean, I mean, take there's a bunch of different cases. I'm not gonna. It's like now it's a very fluent situation where it's like I could think one stock is the best buy on any given day, depending on position size already, and then the next day something else sells off for 20%, and all of a sudden I like that more on that day, whatever. But let's look at, I mean, some let's ponder some low risk ones. Like Integra got sold off. Why? Well, I think it just gets sold off with the rest of the market. In Florida Canyon is probably making because let's face it, oil went down. They have an open pit mine, a lot of diesel and gasoline, so the input costs went down. The tariffs don't, I don't think, impact them much. So I think the value of Integra probably went up actually since the tariffs went into effect, because gold price went up and stayed up, and oil crashed. But the Integra stock sold off. So it's probably actually a better buy now, especially with the price going down. First Nordic went down to, I think on Friday went down to like 40 cents. Is First Nordic worth less than when it was at 60 cents? What has happened since that time? Gold has gone up, oil has gone down. If Barsele was in production, it probably would be making more money now than 3-4 weeks ago. Barsele is fully carried by Agnico Eagle, who's making record amounts of cash. They have what, 11-12 million in cash. They're nowhere near any sort of bankruptcy risk. If anything, what they have is more sought after today by basically anybody who would want to have a tier 2 mine and the optionality for a tier 1 project. So it's, I would say, probably at its peak value, and still it went down to 40 cents. And selling for absolute peanuts on the value of Barsele. So I mean, again, is there a lot of risk in that story? They have a project that's worth multiples of the market cap. Their flagship project is fully carried by Agnico for the time being, and they have a lot of cash. Yeah, I mean, is that risky? Nike looks more risky, Well, in a sense. So it's like there's plenty. I mean, if you have a cashed up junior or a fully carried junior or whatever, and they're selling for peanuts, how risky is that? There should be panic buying in those cases. But only a few will do panic buying when there's panic selling. And I mean, take whatever your favorite junior is. I mean, this is what I think you should ponder. Again, what is risk? Did the silver producers get their value changed? Yes, silver price went down a lot. Obviously, they're going to be making less money today at 20 or 20, whatever the silver price is, $30, $30.4, relative to $35 2 weeks ago or something, or 1 week ago actually. Does it make sense that silver producers especially repriced lower? If they weren't overvalued, or I should say, if they were fairly valued, they should reprice to being fairly valued with a $30 silver price. Yes, that is absolutely rational. There are cheap silver developers who are not pricing in having any sort of chance of having a monetizable project, and let's say they were selling cheaply before silver sold off. Should they go down? I mean, how much should they go down? If they're if they're cheap relative to a silver price of $30 already before the sell-off, they shouldn't have gone down, but they probably did. My point is that there's a lot of stuff in this sector that should go down because the tariffs changed their business economics and their business model, the value of their business model. But at the same time, a lot of stuff went down that didn't go down in value. So that's obviously an opportunity. When value doesn't go down but price goes down, that means you're getting more for your money. You're probably going to make even more from buying those dips than before the dip happened. Again, a case of where if something shouldn't go down at this point, but it went down like that, you're just going to make more money in the future, all else equal. That's a big difference from something that, like Nike, which went down in value and should go down in price. That's just a business value went down with price. So there's no price to value gap that opened up. It was a price to value gap that stayed close. So there's no extra opportunity. But if value went up and price went down, you just found yourself an even bigger opportunity. That's all the difference in the world. Maybe I've gone through most. Yeah, so it's like, let's see what happens today. But it's like, this is go time. The volatile days is when people make mistakes. The market makes huge, absolutely enormous, monumental mistakes. Because again, if you see a junior that shouldn't go down and goes down 20%, that might not be a 20% mistake. That might be a, depending on the level of cheapness and exactly what's going to play out, that might not be I mean, if it went from here to here, let's say, I don't know exactly what kind of dip this is. Let's say this was a 40% dip. That's not a 40 to 50% mistake. That's might be a 1,200% mistake. If we're talking bottom to top. My point is that if you think, oh, something went down 20% from cheap levels, that 20%, that sounds good. Then you're not thinking about how then you're not thinking how much the risk reward changed. The risk reward might change exponentially more than 20%. The future returns might go up 200% on a 20% decline. So that's why when things are cheap, the risk of selling, it just goes absolutely bananas. In hindsight, I wouldn't have complained about any of these returns. In the short time period, you would think you were, oh, I should have sold this. Well, you're going to make 240% on that. And then whatever you buy here, let's say where you would get 350%, it sells off, and you're like, oh shit, I made a mistake. No, you're gonna get 350%. You're just gonna get 392 from any additional buy. And of course, in reality, you have a bunch of these juniors at the same time, just swinging wildly, again, because there's not every single junior is not going to have stop losses getting hit. One junior might have one guy liquidating it because he owns 5 stocks and one happens to be liquid, and when he sells that in panic, that stock just happens to go down like 20%. You have to spot those things. You should be really flexible, and it's grinding time. It's crunch time right now in a volatile market. So what do I hope to happen today, for example? I hope there's more dislocations. I hope there's more panic selling. As long as it's not, since I am fully invested, what I don't want is everything to sell off at 20% at the same time when I don't have any dry powder. Because then it's much harder to spot what might be a better buy than the other. What holding of mine become just a bit better buy than something else. And of course it might be depending on or I should say, think about the risk reward. Yes, if a shitco trading sardine went down an extra. Yes, you might have a theoretically, you know, bonanza type upside ahead, but if you have also a low risk case go down 20%, you might not need to speculate that much. You might get an extra 80% with low risk in that. That's good enough, right? I mean, if you're down 50% in your portfolio, you still only need to the portfolio only quote only needs to go up 100% until you're back to even. So if you find a bunch of low risk probable 400% returners, if you're down 50%, that's not going to be a problem, is it? 100% is going to get you back in in uh, uh, in the green. And let's say the extra, what did I say? Well, let's say 300%. So 100% gets you back to even Steven. The last 200% gets you to double your portfolio. And let's say that happens over 3 years. That's not a bad return over 3 years. That's a doubling. That's, I don't know what that is per year, but that's got to be, what, 25% per year? That's actually a good return, even though people don't think it is. Because everybody will always expect that, oh, I'm just going to be part of the moonshots. And it's like, I mean, I've been in every single rally from bottom to top. That does not mean that my portfolio averaged 1,000%. You know, I mean, my longest term portfolio, that might be averaging like 50% per year, and that sounds too low to that sounds low to a lot of people, but that becomes a 10 bagger pretty quickly. 50% per year, yeah, over over 5 years. I don't know exactly what. Let's, yeah. I mean, you do the calculations. I hope you got something out of this. My point is, or the takeaway is, if you're fearful and think about panic selling, you're no different than any of the 95% that don't make any money. Smart, rational, selective, let's say value shuffle makes all the sense in the world, and don't believe where is it? Did I close it down? Like Howard Marks says, everybody runs from the market when prices go down because they think it cannot reach. It's just stuff going on sale. Again, look at the selling as just stuff going on sale. Because most of the time, especially in the junior mining sector, it does not mean that value went down. Or especially not enough for them to not be on sale. So just look at that. Somebody is willing to sell their ownership of a company's assets at cheaper prices. If you think that's stupid, if you think that's way too low to be selling your ownership of those assets, that's a buy. The market is not often right, but it's especially true when you have emotional selling and stop losses and stuff. How many good stories do you think investors have from from selling panic lows, selling a depressed sector? How many do you think is like, oh, yeah, I was one of the panic sellers, or I had my stop losses hit because the sector was crashing? How many do you think have good follow-up stories? Compare it to anybody else who sells any or buys any of these sharp corrections. Fast forward the time. Look at any one of these sharp corrections. This sharp correction would be in profit here. Yes, this took years, so I get it that it's not like easily recognizable that this actually was going to turn into a good buy, because it was probably down like 80% down here. My point is, if you're totally rational about it, you can see that it would be a mistake to sell any one sharp correction in a cyclical sector, especially if we're already low. Obviously, I mean, this was from a high sharp correction, but this was from a correction at lower lows, and this sharp correction was from even lower highs, I should say. So this sharp correction proved to be a much better buy than this sharp correction, and this sharp correction proved to be a better buy than this, and this proved to be a better buy than that, and this proved to be a better buy than that. So what you can tell is that the lower it goes, the higher the future returns and the shorter time period. Because this was the last correction from the lowest price. This was the last dip. That means this is closer to the high in time than this, and this was closer to the high than this. So that means quicker returns from lower levels. So it's not only higher returns the lower it goes, but the lower it goes, then the longer it has been down, it's also closer to the rally happening. So the compounding effect is monstrous. Imagine, let's say this is 1,500%, and this took 6 months to play out. This might be 200% from here to here, and it took 3 years to play out. So the difference between 3 years and 200% and 1,500% in 6 months is absolutely monstrous. Absolutely enormous. A chasm. That's why if you're past the point of selling, don't effing sell. The only thing we know if the bottom is not in yet is that we're getting closer and closer to this bottom and the absolute best buy you can ever get. So if you're anywhere close, all of these buys would be in the green. All of these buys would be in the green. All of these buys would be in the green. In the meantime, you might have minus 50%, minus 70%, yada yada. Doesn't care. It doesn't change the fact that every single one of those somewhere near bottom buys were gonna turn into profits. I mean, at this point, every single buy below this line for the last, I don't know how, 6 years or 7 years proved we're gonna be in a profit. At this point, every single buy for the last 15 years or 10 years, we're gonna show a profit. So nobody can tell me how bloody hard it is to. I mean, if you're just good at buying dips in this sector or buying lows, I don't know how you're supposed to. Unless you have some very poor stock picking skills, you shouldn't lose money in this sector. But you will forever if you're one of the panic sellers that's, panic selling now when we might be like either here or here or here or here or even here or whatever. You get my point. The only reason I make money, I was going to say, is that I do stock picking and I refuse to sell if I think we're even close to our bottom. I just ramp up my buying the cheaper it gets. So, yes, thanks for listening. If I mention any companies, assume I'm biased. I might own shares of them. They might be banner sponsors. This is a risky business. Well, you can make it very risky if you don't know what you're doing. But yes, for precautionary statements, don't invest money you cannot afford to lose. And especially, I mean, if you're in illiquid juniors, it's like, you know that you can't be, I mean, don't put all your, if you think you might need that money within 2 years, don't put put that money in a bunch of illiquid juniors where you have to, because let's face it, there's people who need to sell for no other reason than whatever, pay the mortgage, buy a car, whatever. So there's also forced sell. People who don't even want to sell, but they need to. They know how cheap it is, and if you're only in illiquid juniors, you have to sell into an illiquid junior and get a 20% haircut, and that's not fun. So don't have everything in like illiquid juniors, especially if you need the money. Thanks for listening. Let's have a great day out there. I mean, it's funny. One last point. It's like, I think it was Friday. Or maybe it was Thursday. But the market started crashing. Yeah, portfolio down. And it's like, but it was a beautiful spring day here in Sweden. It's like I I had a good mood that entire day. And that tells me, it's like, yes, I am very rational about things. Because I can see that this is just a momentary irrational price decline in my portfolio, in the stocks I own. Because I'm very, I look at the fundamentals and I'm loving them more than any point in time before, let's say. So I'm very, very, very comfortable, and I'm very, very convinced some point in the future portfolio is going to be up a lot from these levels. So I don't worry about it. I mean, when I played poker, if I lost $100, I could become absolutely ballistic, because that's money I'm never getting back. If my portfolio does this, I don't worry too much about it, because I know it's going to do that as well. So it's just the market borrowing money from me in a sense. Because if the value didn't go down and price go down, sooner or later price is going to match value and probably overshoot it actually. So that doesn't worry me. It's like it's a momentary thing. I'm living in the future already. I'm licking my chops thinking where this sector always goes from these levels. So it's not a permanent problem. But if you're only in shitcoast and have no idea what you're doing, you don't even know where you are. I hope you get some kind of copium from that. Anyway, thanks for listening. Bye.